We're looking at a stock to consider for our portfolio. We understand its business model and the questions we need to ask. Now we need to understand how is it doing. And while we could ask the company, we could go to its website, there are tons of places where the company is happy to tell us how they're doing. We want to cut through the words and get to the numbers. To do that, buckle up, because we're going to dive into the financial statements for the first time. Not too deep, we're going to skim the surface, and we're only going to need to use 3rd or 4th grade arithmetic, so the math won't be complicated. And to keep things as simple as possible, I selected a nice plain Jane company, General Mills. General Mills is a food company. They make all these types of food, and they have all these types of famous brands that you're familiar with. To read about General Mills results, we're going to go to their 10K filing, which is available on Edgar. Edgar is a website that is not a homage to a famous American suspense writer, nor to one of the greatest designated hitters in American League Baseball, but instead, it's just a dumb acronym. It's where you can find all the filings from publicly traded companies. General Mills just filed their 10K, their annual report, because their fiscal year ends in May instead of in December, and that's part of the reason that I chose to look at them. Before we dive into the filing, there are some things that we can presume, or that I'll presume. I've never studied that many food companies, and I've never studied General Mills for sure, but there's some things that I can presume off the top that will follow through. The pandemic and inflation may have had an impact on their business that we can see in the numbers. I would expect this to be a slow-growing company because food is not a new category. It's not so much innovation going on in the space. It's something that we need. It's a staple. We always need food, and so I wouldn't expect fast growth. I would expect them to be paying a dividend to shareholders because that's just something that steady, slower-growing, longer-lasting companies do. I would expect their business to be stable, their financial position to be fairly stable. They've been around for 150 years. And lastly, I would expect that they would be reasonably profitable, but without crazy margins, because I would expect a lot of competition. With all that said, let's ask the first most basic question. Is the company growing? To answer this question, we need to use the income statement. The income statement is the first of 3 major financial statements you'll see in every filing. On the income statement, we're going to go to the top line, the net sales or revenue figure. This is the top line, and that's what we usually mean when we ask, is a company growing? Are they selling more of whatever they sell this year than they did last year, next year than they did this year? We look at General Mills' statement. We see 3 years from 2023, 2022, 2021, left to right. And if we start at 2021, we see a little over $18 billion in sales that year, then a little under $19 billion in sales the following year, and in the last year, a little over $20 billion in sales. General Mills is indeed growing. We can calculate a growth rate quickly. Take 2023's number, divide it by 2022's number, subtract 1. You have a growth rate of 5.8%. That is one of their best growth rates in the last 5 years. It was 4.8% the year before, 2.8%, 4.5%, and lastly 7.1% in 2019, but they had a big acquisition that year, so just keep that in mind. The answer to our question, 5.8% growth, not bad for a stodgy, slow-growing company like General Mills. Are they becoming more profitable? Sales growth is well and good and necessary, but if it's not translating to increased profitability, that can become an issue. To measure this, we're going to look at margins. How much is left over after General Mills takes care of things it has to pay or things that are costs to its business? There are 3 different margins we can look at. Gross margins, it's margins after you just account for how much it costs them to make the stuff that they sell, how much it costs them to make Cheerios or Betty Crocker or whatever else. Then operating margins, how much they make after you factor in all the costs to just run their business, all the people they have to pay, all the buildings that they have to keep up, and so on. And then net margin, which is how much they make after you throw in interest and taxes. That's the bottom line. Net margin is ultimately what is left over for shareholders, at least in theory. We'll come to it in a second. Let's go back to the screen. What we see here, General Mills doesn't actually break out a gross profit line like a lot of companies do, so we have to do some basic calculation. Cost of sales divided by net sales gets us the gross cost percentage. 1 minus that will get us the gross margin percentage. Or net sales minus cost of sales gets you your gross profit dollars. We're focused right now on gross margin percentage. When we do the math, we see that in 2020, it was 34.8%. That's not on the screen, but it was 34.8%. We got up to 35.6% in 2021, but then in the 2 years following, it dropped all the way to 32.6%. So inflation indeed is eating away, at General Mills margins. When we look at operating profit, we can see straight away that it dropped in the last year, so the margin must have dropped in the last year too, since sales went up. We can again calculate the math, and it went from 16.75% in 2020 to a peak of 18.3% in 2022, and then back down to 17.1% in 2023. I mentioned earlier I didn't expect them to be super profitable. 17% operating profit is a pretty fat cushion, and it's no surprise that they make a pretty good net margin as well. They do have some interest, and then of course they're paying taxes, and so then we get to a bottom line of about $2.6 billion this year, which is a net margin of 13%. For a company like General Mills, without knowing the industry well, just as a first starting point, this seems like a reasonable number. To really understand it, we would have to compare it to its competitors, and then we would also have to compare it to the price of the shares to understand if you're getting a good value. But we'll save that for later. You can also see their earnings per share. You see that they went from 3.78 up to 4.42 and back down to 4.31. And you can see that they do indeed pay a dividend, one that has grown the last 3 years. Is this company stable? To answer this question, we need to start looking at other statements, the balance sheet and then the cash flow statement. The balance sheet tells us the financial position of the company. How much does it own? How much does it owe? And how much is left over for shareholders? Assets, liabilities, and equity. Let's have a look. I circled a few things on General Mills' balance sheet that I usually zoom in on. First, in red, I circled its cash on the asset side and its debt on the liability side. I wanted to see, is it in a net cash position or in a net debt position, and how much? Debt is just money that it's borrowed. Cash is money that it has in the bank or wherever that it's able to use. We can see that it's in a net debt position of $11 billion. It sounds like a lot, and I prefer to invest in companies with net cash. That said, for a slow-growing, steady, predictable business, it's not surprising that they have debt on their balance sheet, and $11 billion of debt compared to $10.7 billion of equity, as you see on the bottom, suggests that they're not terribly leveraged. They don't have so much debt on their balance sheet. It doesn't seem irresponsible, at least at first glance. The next thing I can look at is the current ratio. How do their current assets cover their current liabilities? This would give you an understanding of, in a pinch, would they be able to liquidate everything that they have that they can turn into value right away and cover all of their liabilities? They're a little bit short of that. Their current ratio is something like 0.66. It's not the end of the world. It's unlikely that they would suddenly need to cover all of their short-term liabilities, and also most of their liabilities are accounts payable, which means money they owe to their suppliers. You would think General Mills will be able to work around that. But it is worth checking, especially as you look at smaller companies, what this looks like and how they would do in tough situations. The last thing I circled is what I mentioned earlier, equity. All things equal, you want equity to grow over time. This is the value left over for shareholders. In a company like General Mills, where they probably don't have a lot of places to invest their equity, it's not surprising that even though they made $2.6 billion in profit last year, their equity actually decreased a little bit. I'll explain why on the next sheet, the cash flow statement. The cash flow statement is arguably the most confusing and advanced of any of the statements, but again, we're only zooming in on a couple things right now. First, my favorite measure of profitability, free cash flow. Essentially, how much money is left over for shareholders after the company pays down all of its debt earlier, but also after it invests in its own future, invests in equipment, invests in new plants, whatever else. That's what's left. Once they invest in what they need to continue to grow the business, how much is left over. You're looking for net cash provided by operating activities, and then something like capital expenditures. In this case, General Mills calls it purchases of land, buildings, and equipment. Other companies will call this a little bit different. It's often, but not always, the first line in cash flow's investing activities. It will always be under investing activities. That's where we have the free cash flow number. It's about 2.1 billion when you do this math. This minus this. 2.1 billion. A little bit less than their net income, but still a fairly solid number. Again, we don't have the full context yet. The next thing I want to point out, let's go down to here. In the financing activities, we see purchases of common stock for treasury and dividends paid. This is what I was just mentioning. They spent $1.3 billion on dividends last year and $1.4 billion on buying back stock. This is how you reward shareholders. You either buy them out and so that they can get out and invest in something else, or you pay them a dividend and they stick around. This is the theory for why we would own shares in a company in general. It's not surprising, again, as a steady, predictable business without a lot to invest in, they would pay back their shareholders. There is 2.7 billion, which is a little bit more than the 2.6 in profit that they made last year. And that explains why their equity didn't grow at all, despite having such a profitable year, because they were paying out shareholders. The last thing of note, I circled an acquisition. They had a $1.2 billion acquisition in 2022. I circle it because we started with sales and whether sales are growing. If a company is buying other companies, it's easy for their sales to grow because they're just adding the new sales in. But that's not organic. And I don't mean because the company doesn't make organic food. It's not organic. It's not natural to their business. And so companies will often have an organic growth rate where they adjust for acquisitions. So you're comparing apples to apples from 2023 to 2022 and so on. So that's just something to keep in mind. Is your stake in the business growing or decreasing? This is our last question. It's actually not quite as important as the other ones, but it is worth asking because especially as you look at some types of companies, your stake in the business will be decreasing over time, and that makes the investment less attractive. Let's start again in the cash flow statement to answer this. You see in red, I circled stock-based compensation. Stock-based compensation is when a company pays their employees with shares or options instead of in dollars, instead of in their salary. It's a legitimate form of payment. It's something that tech companies especially like to do, and investors often argue with how they should account for this. It's normally included as a cost in the income statement, but then is added back to the cash flow statement because it's not actually dollars, it's shares. And then companies will often adjust and give you non-official earnings adding back stock-based compensation. And that's the controversial part. General Mills is a stodgier company, no offense, and they don't have very high share-based, stock-based compensation, so it's not really a factor here, but it's just something, if you're wondering why earnings per share aren't going up, this is one of the first culprits to look at. The next thing we want to look at, though, is, okay, but are they actually increasing or reducing the share count? And there's an easier way to look at this. We're going to go back to the 10K itself. You'll see right at the top of the 10K, all this formulaic stuff, but one of the formulaic items is number of shares of common stock outstanding. You see 585 million shares and some change. We can compare that to the same number from last year's filing and see whether it went down or up. In this case, it went down 2%, so they've reduced the share count 2%. That means if you owned one share in General Mills in 2022, it counted for point whatever percent of the business, and now that's 2% better this year. It's not a huge change, but over time, companies that reduce the share count, that's usually a good sign that A, they're profitable, that they can afford to do that, and that they don't need to raise capital, but also that their shareholders will do well because they're going to own more and more of a growing, profitable business. That's the last thing that I wanted to point out in these initial questions. We've learned a lot of the hows for General Mills, how their business is doing, how much it's growing, how stable the business is, how profitable it is. We don't know any of the whys yet. For that, there are a number of places we can look, and I'm going to go over a bunch of them later, but I want to mention quickly that in the 10K form, Usually item number 7 is going to be management's discussion and analysis of financial condition and results of operation. And what this will offer is what they call in the business color on the results. Explain what happened, give you details on why sales grew 5.8% last year, why operating profit reduced last year. Often there will be a lot of boilerplate, though if it's your first time looking at it, it's useful to understand how the company thinks about itself and how they think about their strategy going forward, the management team. But also it will give you details on why things happened the way they did, which you're going to find in other places as well, and which will be important too. You can't just stop at the numbers. You start there and then understand what's going on. Okay, that was a lot. But you now understand how General Mills' business is going. And if you like what you saw, do you think that's enough to make a buy decision? Not so fast, my friend, because we still need to understand the price we're paying for these shares and for these earnings. We need to go into the valuation. That's what I'm going to talk about in my next video. Subscribe to this channel to get it when it comes out next Monday. Check out Short Investing Guide for more details on this video and on what I did as I was looking through the financial statements. Leave a comment if you have any questions. Thank you for watching, and see you next time.